Welcome back to Money Smart Basics. My name is Alfonso Brooks Bay. Let me ask the class a question. How many of us have been told credit matters if you want to buy a house, finance a car, or qualify for a loan? That is true. But what if I told you credit may also impact your retirement? That's right, retirement. Because every extra dollar paid in higher interest, higher monthly payments, or costly debt may be a dollar that never makes it into savings, never makes it into investments, never helps build future income. Think about that. If poor credit causes you to pay more for a mortgage, more for a car, more on credit cards, then part of your wealth may be leaking out every month. And over time, those leaks can become large losses. Now, let me write something on the board. Credit affects cash flow. Cash flow affects savings. Savings affects investments, and investments affect retirement. That is the connection. And that is what this lesson is about today. In this class, we're going to look at how bad credit can quietly hurt retirement, how good credit management may help you keep more of what you earn, and how debt management can help redirect money into wealth building. And before we finish, I'm going to show you practical ways to improve credit, reduce financial leakage, and begin building what I call a financial pipeline. So take a seat, lean in, and let's begin. The hidden retirement leak. Most people focus on what they earn, but wealth is often shaped by what leaks out, and one of the biggest leaks is interest. Let's look at a mortgage. Imagine two buyers. Both buy a $300,000 home. One has strong credit, one has poor credit. The buyer with stronger credit qualifies for a lower interest rate. The buyer with poor credit pays a higher rate. That difference could mean hundreds more each month. Maybe $300, maybe $500, maybe more. That may not sound life-changing, but over 30 years, that could be over $100,000 in extra interest. Money gone. Now imagine that same $300 a month was invested instead. Month after month, year after year. What could that have become? That is where the retirement conversation begins, not just with saving more, but by stopping financial leakage. And this doesn't stop with mortgages. It shows up in car loans, credit cards, insurance premiums, even rental applications. Bad credit can become an invisible tax, and invisible taxes can destroy visible wealth. The compounding cost of bad credit. Here's what many miss. Interest compounds against you, or investments compound for you. One works for you, one works against you. Imagine carrying $8,000 in credit card debt at high interest, making minimum payments. You may pay thousands in interest, maybe more than the original balance. Now imagine taking those same payments and directing them into investments. That money could be working for you. This is why debt management matters. It is not just about becoming debt-free. It is about redirecting cash flow, and redirected cash flow can build wealth. Think of it this way. Every dollar not paying unnecessary interest can potentially become a worker, a wealth-building employee. That's the shift. Stop seeing dollars as spending tools only. See them as future income producers. That changes everything. The retirement cost of high payments. Let's go deeper. Suppose poor credit causes $250 higher car payment, $300 higher mortgage payment, $150 in revolving debt payments. That's $700 per month. Gone. That is $8,400 a year. Over 20 years, that's $168,000. And that's before growth. If invested, it could potentially become far more. This is where many people lose the retirement game. Not because they never earned enough, but because too much cash flow leaked out. Retirement is often a cash flow problem before it is an income problem, and credit affects cash flow. That's why credit matters. Good credit as a wealth tool. Now, let's flip the script. What happens when credit improves? Lower interest rates, lower payments, better terms, better approvals, more financial flexibility. Now imagine you improve your credit and save $200 monthly on a refinance, $150 on car financing, $100 through lower insurance. That's $450 monthly, $5,400 annually. What if that goes into savings? That's the beginning. But what if it goes into investments? Now you're building a system. This is the difference between consumers and builders. Consumers focus on payments. Builders focus on cash flow, and cash flow creates options. Good debt management can build thousands. Let me show you something powerful. Suppose you redirect $500 per month that used to go toward wasteful interest into savings. That is $6,000 a year. 5 years, $30,000. 10 years, $60,000. And that's before interest. Now, if part of that grows, it could be much more. This is how people quietly build wealth, not always through giant windfalls, but through disciplined redirection. And remember, this connects to my 20-50-30 concept. Pay yourself first, before lifestyle expands, before spending grows, before debt takes over. Build the habit, then build the system. The credit score and retirement readiness. Some people think, once I retire, credit won't matter. That can be a dangerous assumption. Credit may still matter for refinancing, downsizing, medical financing, emergency borrowing, insurance costs, even housing options. Strong credit can provide flexibility. Weak credit can reduce choices, and retirement without options can be stressful. Good credit doesn't guarantee security, but bad credit can make insecurity worse. 5 ways to improve credit before retirement. Number 1, lower credit utilization. Don't max out revolving accounts. Keep balances controlled. Number 2, pay on time. Payment history matters. Protect it. Number 3, attack high-interest debt first. Stop feeding expensive balances. Number 4, review your credit reports. Errors happen. Dispute mistakes. Number 5, use savings and debt payoff together. Don't choose one without the other. Build both, emergency reserves and debt reduction. That is strength. The wealth drain versus wealth pipeline. Let me show you another way to think about this. Bad credit can act like a wealth drain, like a pipe with leaks. No matter how much water you pour in, it keeps leaking out. You get a raise, but interest eats part of it. You pay off one debt, another high payment shows up. You try to save, but the extra cost of poor credit keeps draining the account. That is how many people stay stuck, not because they do not work hard, but because the system is leaking. Now, compare that to a wealth pipeline. A pipeline does not leak. It channels resources efficiently. That is what good credit and debt management can do. It helps direct money where you want it to go, toward savings, toward investments, toward retirement. Let's use a simple example. Suppose improving your credit saves you $200 a month on a refinance, $100 on insurance, $150 by eliminating high-interest debt. That's $450 monthly. Instead of letting that money disappear into lifestyle spending, you redirect it. Part into an emergency fund, part into retirement, part into investments. Now a pipeline has started. And once a pipeline starts, it can grow. One stream becomes 2, 2 become 3. Savings grow, income grows, options grow. That is how systems are built. And this is what many miss. Retirement security is not only built by how much you save, it can also be built by how much cash flow you recover. Recovering cash flow is like finding hidden income, and hidden income invested over time can become visible wealth. This is why improving credit is not just about borrowing. It can be about building, not just repairing damage, but creating a system, a pipeline. And pipelines can help fund retirement. The mindset shift here is where many people struggle. They think, I just need more income. Sometimes you need less leakage. You do not always solve a cash flow problem by earning more. Sometimes you solve it by keeping more. That is why credit management matters. That is why debt management matters. That is why mindset matters. Because wealth is often not built in dramatic moves, but disciplined ones. Your 90-day credit and retirement reset. For the next 90 days, do this. Month 1, audit every debt, every interest rate, every payment. Find leaks. Month 2, reduce one major debt, improve utilization, build savings. Month 3, Redirect one freed up payment into investing. Begin your pipeline. Just start. Do not try to fix everything. Focus, following one course until success. And remember luck, laboring under correct knowledge. Closing bad credit does not just affect borrowing. It can affect your retirement. But here is the good news. Credit can improve. Debt can shrink. Cash flow can recover. And wealth can be rebuilt. One decision at a time. One payment at a time. One habit at a time. The question is not, can it be done? The question is, will you begin? If this message helped you, type, "I'm building my pipeline" in the comments. Like this video, share it with someone thinking about retirement, and subscribe for more financial literacy that helps you build income, reduce risk, and prepare for the future. Because retirement should not be built on hope alone. It should be built on strategy. I want to invite you to go deeper. I created both the book and companion workbook, Debt Free in Jesus' Name, to help you move from information to real transformation. This isn't just motivation. It's a step-by-step biblical blueprint designed to help you break the cycle of debt, strengthen your mindset, and build a foundation for long-term financial freedom. The book will teach you the principle, and the workbook helps you actually apply them, with practical tools like budgeting guides, debt payoff strategies, and personal reflection exercises. If you're ready to become a better steward of what God has placed in your hands, the links are in the description. Start your journey toward peace, discipline, and financial freedom, one decision at a time. The information provided in this content is for educational and informational purposes only, and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.